Welcome, class. Today, we're going to dissect a concept that is absolutely fundamental to corporate finance and strategic decision-making, the true cost of debt. Now, for anyone in this room who wants to lead a business, manage a division, or just make smart financial choices, understanding this isn't just some academic exercise, it's essential. We're going to go way beyond the surface-level numbers you might see in a press release and really uncover what a company truly pays from an economic standpoint when it decides to take on debt.
So let's kick things off with a foundational question you're definitely going to face. Imagine you're analyzing a company's financials, and you see they just issued a new bond with a 5% coupon rate. Your first instinct, and trust me, this is a very common mistake I see students make, is to just assume, okay, 5% is the cost. It seems logical, doesn't it? I mean, it's the number printed right there in the bond certificate. But as we're about to discover, the world of finance is rarely that simple. So is that 5% the whole story? The answer is a hard no, and understanding why is really the entire point of our discussion today.
Most people, when they first start learning about this, they look at that stated interest rate, which we formally call the coupon rate or the nominal rate, and they treat it as the final word. The best analogy I can give you is the sticker price on a new car. It's that big, flashy number on the window, the MSRP. But as anyone who's ever actually bought a car knows, that sticker price is almost never the total cost of ownership, right? Once you start factoring in taxes, dealer fees, and financing charges, the real cost is something else entirely. Well, the coupon rate works in pretty much the same way.
Now, don't get me wrong, this coupon rate is still very important. Its main job is to determine the periodic cash payments the company has to make to its bondholders. So if a company issues a $1,000 bond, what we call the face value or par value, with a 5% stated rate, that literally means it's going to pay $50 in cash interest every single year. It's a predictable, known cash outflow. But, and this is the key, it's just one piece of the puzzle. It represents the interest expense from a pure cash flow perspective, but it absolutely does not capture the complete economic cost that the company takes on over the life of that bond. All right, so now we're going to move from the superficial to the substantial. The real story, the true cost, is kind of buried in the details that go way beyond that simple coupon rate. A smart financial manager and a skilled analyst knows that the most important numbers are often not the most obvious ones. So we've got to look at the initial transaction itself. What's really going on here?
So our source material lays it out for us perfectly. The total cost of borrowing isn't just one thing. It's a combination of three distinct elements. First, you've got the interest payments we just talked about, which are driven by that coupon rate. Second, and this is where things get interesting and market dynamics come into play, you have the effect of any discount or premium on the bond when it was first issued. And third, you have the direct out-of-pocket issuance costs. To get to the true economic cost, we have to analyze and combine all three of these. So let's break each one down.
Okay, this concept right here is absolutely central to finance. It really gets to the heart of the time value of money. The critical question isn't just how much cash do I have to pay out in interest every year. The real question is, how much cash did I actually get at the very beginning of this whole thing compared to the total amount I'm on the hook to pay back over the bond's life? That difference, the gap between the net cash you receive up front and the face value you pay back at the end, that represents a very real, even if it's a non-cash, cost or benefit. So let's talk about a bond discount. Imagine our company needs to borrow $1,000. That's the face value it promises to repay in 10 years. But maybe its stated 5% interest rate is a little bit lower than the current market rates for similar debt. Well, in that case, investors might only be willing to pay, say, $980 for that bond today. So the company gets $980 in cash, but it is legally obligated to repay the full $1,000 when the bond matures. So what about that $20 difference? It's not a loss on day one. From an accounting point of view, it's a form of deferred interest cost. It's an additional cost of borrowing that has to be recognized systematically over the 10-year life of the bond through a process called amortization. Each year, a little piece of that $20 discount gets added to the interest expense, which effectively increases the company's total borrowing expense.
Now, let's just flip that scenario. What if the company's bond has a stated rate that's actually higher than what the market is demanding? Well, now that bond looks really attractive, right? Investors might be willing to pay a premium for it, maybe $1,020, just to get those higher interest payments. In this case, the company gets $1,020 in cash today, but it still only has to repay the $1,000 face value at maturity. That extra $20 it got up front is a financial benefit. It effectively lowers the overall cost of the loan. And just like the discount, this premium isn't recognized as income on day one. It is amortized over the bond's life, which reduces the recorded interest expense each period.
And finally, we've got the most direct costs of all, issuance costs.
Bringing a multi-million or even a multi-billion-dollar bond issue to the market is a really complex process. You need investment bankers to structure the deal and find buyers. You need lawyers to draft hundreds of pages of legal documents, and accountants to audit all the financials. And those services are not free. These fees are a direct cash outflow that's required just to get the loan in the first place. And accounting rules require that these costs are also deferred and amortized, which further impacts the true cost of borrowing. This slide just perfectly illustrates the gap between a simplistic view and the complete financial reality. On the left, you've got the common mistake, only looking at the stated rate, which is just the tip of the iceberg. And on the right, you have the professional standard, a comprehensive calculation that includes the cash interest payments, the impact of the discount or premium, and all the issuance costs, everything that's lurking below the surface. Operating with the view on the left leads to bad analysis and poor decisions. Operating with the reality on the right, that's what leads to sound financial leadership.
So this creates a bit of a puzzle for us, right? We have periodic cash payments for interest, a non-cash amortization of a discount or premium, and these initial cash outflows for issuance costs. How in the world do we combine all these different types of costs, which are all happening at different times, into one single coherent number that we can actually use to judge the true cost?
Well, the solution is a really powerful financial tool called the effective interest rate. You'll also hear it called the yield to maturity, or just the market rate. This one single percentage is designed to do exactly what we need. It synthesizes every single cost and cash flow component we've talked about, the cash payments, the premium or discount, the issuance fees, and it boils it all down into one number that represents the true all-in economic cost of that debt over its entire lifetime.
And this slide just nails the concept, straight from our source material. This rate isn't just some abstract calculation. It is the definition of the actual financial impact on the company. If you want to get mathematical about it, it's the internal rate of return, the IRR, of all the bond's cash flows. It's that one unique interest rate that perfectly equates the present value of all the future cash you'll pay out, the coupons and the principal, with the net cash the company actually received on day one. It is the true time-value adjusted cost of those funds.
So let's bring this all together. The crucial point here, and if you remember one thing from today, I want it to be this. This is not just an accounting exercise to make sure our journal entries are correct. Understanding and calculating the effective interest rate is an absolutely critical tool for strategic capital budgeting and financing decisions. This is where accounting directly informs and drives business strategy.
Okay, let's do a little role-playing. You are now the chief financial officer of a major corporation. You're presented with two different ways to finance a new factory. As you can see here, Bond A offers a 6% stated rate. Bond B has a slightly higher stated rate of 6.2%. Now, the rookie analyst, just looking at the sticker price, would immediately recommend Bond A. But you, because you've done the proper analysis, you find out that due to market conditions, Bond A has to be issued at a pretty big discount and it has higher issuance fees. When you actually run the numbers and calculate the effective interest rate, Bond's true all-in cost is 6.5%. Bond B, on the other hand, can be issued closer to par. With lower fees, its effective rate is only 6.3%.
And right there is your decision. Clear as day. The bond with the higher sticker price, Bond B, is unequivocally the cheaper, better financing option for the company. Without calculating and comparing the effective interest rates, you would have made the wrong choice. And over the 20 or 30-year life of that bond, that seemingly small difference of 0.2%, we call that 20 basis points in finance, could translate into millions of dollars in extra unnecessary interest expense. That's a direct hit to your company's bottom line and ultimately to its shareholder value.
So what are the key principles you need to take away from our lecture today? First, and I can't stress this enough, never ever mistake the stated rate for the true cost. Second, understand that discounts, premiums, and issuance fees aren't just accounting fictions. They represent real economic costs or benefits that have to be accounted for. Third, when you're comparing different debt options, the effective interest rate is your single source of truth. It's the only number that allows for a true apples-to-apples comparison. And finally, mastering this concept is what separates a bookkeeper from a strategic financial decision maker. This is how you create value and prevent some seriously expensive mistakes.
We'll leave you with this final thought. This idea of looking beyond the sticker price for hidden costs and calculating a true effective rate, it goes way beyond the world of corporate bonds. Think about taking out a student loan or a mortgage. Sure, there's the advertised interest rate, but what about the origination fees, application fees, closing costs? All of those function exactly like bond issuance costs and discounts, and they all increase the effective annual percentage rate, the APR, that you actually pay. Applying this critical lens is a skill that will serve you not just in the boardroom, but in your own personal financial life. So always ask yourself, what is the true all-in cost?